Hello, everybody. Economic Ninja here. I hope you're doing well. To say that we are on the cusp of the greatest opportunity of your life is the understatement of the century. And I say century because an opportunity that has presented itself as it has right now with the banks collapsing has not happened for a century. I am going to go over two news stories today, and why they are so important is because the mainstream puts them out, but they're put out so fast you barely get to read them, digest them, and then have somebody around you to be able to put them in context. Somebody that was living through this on a much smaller scale during the Great Recession and the events leading up to it. As I was liquidating my homes, I was reading very similar but much lighter stories in 2006, 2007. We have two stories. One about a bank that has already collapsed, its assets all divided up by the FDIC. But there is one asset that none of the banks want to touch. They still cannot get rid of these assets. Why? Because other banks, most banks, are trying to get rid of their assets. This paper is going to be cut down so much. And in the coming years, you are going to have such an opportunity to take advantage of this only if you're ready. The second story is about the amount of cash that banks are holding on hand because they are straight up fearful. We know about American Express holding a massive cash hoard right now, an amount that they have never held ever in history, and it's held specifically for people that are not about to pay their payments, their credit card payments. The economy is collapsing, and you need to understand how to take advantage of this. Now, before I get into this story, I have an announcement. I myself have consultants in my life as well. I used to be a consultant and helped a lot of people, but I am in the mode where I want to be able to help people and be able to give them knowledge and information, but also I have to seek knowledge and information. When it comes to my real estate course, I've went through all of the comments, all of the reviews. I had a consultant tell me to stop selling it for that much. We've got too much information on there. And so this will be the last week that I ever offer it for 80%. And I'm not joking. We've gotten to the point where it's getting too valuable. We're getting too close. So I'll put a link above, but then after this week, I will cease to stop selling it for this price. So I'm just letting you know that. Here we go. Buyers, this is the big news. I mean, we got two news stories. They're both big, but they're equally large but different. All right. Out of US News .com, buyers sought for Signature Bank's 33 billion in commercial real estate portfolio. Now, why would commercial real estate affect you if you only want to buy a single family home? Or let's say you want to start a rental business, you want to start bringing in cash flow and build generational wealth, and you want to just do it in residential, single family, maybe a duplex or triplex. It's because these losses are about to translate into mortgage-backed securities, and we're already seeing a little shakeup that I've already reported on. I'm going to start reporting on in mortgage-backed securities. All right. This is going to cause loans to increase, fees to go up, banks to close their doors. And Signature Bank, I want people to understand, close their doors because of their commercial real estate assets. All right. Their CMBS, commercial real estate mortgage-backed securities. It's a big deal. So let's dive in a little bit. The U.S. Federal Deposit Insurance Corporation, FDIC, is seeking buyers for the 33 billion commercial real estate loan portfolio of failed New York lender Signature Bank, it said on Tuesday. So as of right now, there is still not a buyer. So these assets have already been marked down for fire sales, but you can't find a bank to buy it even at a majorly discounted rate. Thank you so much, Ren, for the super chat. You can't even find a bank to buy this at a majorly discounted rate because their commercial real estate portfolios are all hemorrhaging right now. If you add on top of that any banks that also have a bond portfolio that they've been holding to maturity, it's collapsed in value. Sure, it's bringing in a rate of return, but that rate of return is nowhere near what inflation is. And so, as a matter of fact, it's nowhere near what those banks could get as a rate of return if they just put their money on loan with the Fed, if they had any extra money. Okay, so this is a big deal. Understand that these banks are all collapsing because of their commercial real estate holdings. It is much, much worse than 2008. I also want you to know this. Before COVID started, this was already an issue. CMBS were already on shaky ground. COVID exacerbated the problem because so many buildings were left empty. And then not only that, the workers weren't there. Then businesses started to close because of inflation. So we have such a massive, massive problem. We have triple net leases that are imploding. We have big office towers that are imploding. It is bad. All right. The majority of the portfolio comprises multifamily properties, primarily located in New York City, the regulator said, adding it would be marketing the assets over the next 3 months. Let me stop there as well. It's one thing to try and buy a single family home as a rental and then a couple more and own 10 and have some cash flow. You're about to see an opportunity that you are never going to witness again when you want to buy 5 units and up. Think about if you wanted to go and buy a ton of, Daniel talks about buying silver and copper. That's great and all, but when you can transfer that silver as it goes up, think about this. In 2008, silver hit its bottom, right around $9 an ounce. It then went from $9 an ounce to about $48 and change a couple of years later. In that amount of time, real estate fell almost 50% in a lot of places. And in the Midwest, where it wasn't affected as bad, it fell 17%. This time is much worse because the Midwest and all these other places had boom times. So I imagine a day where you're going to see real estate fall off a cliff at an average of 50%. Why? Because of a depression, a mini depression, coupled with massively higher mortgage rates, higher than we're seeing right now. All right. So if you're not ready for this, you're going to be left out and you are going to be bummed. I'm not kidding, but you don't have a ton of time. Yeah. Do we have 2-3 years till you see the bottom? Absolutely. But when you, in real estate investment terms, and any of the real estate investors can throw down their comments below because I know they're going to agree with me, that's nothing when you're talking about getting prepared for an opportunity. It says here the FDIC has been seeking to sell off portions of Signature, one of 3 larger banks that failed in the spring, since the bank was closed in March after the exodus of depositors seeking higher returns and safer institutions. Let me stop there. A year and a half ago, I started saying that this year, 2023, will identically mimic 2008. I did a video about a year and a half ago, and I used 2008, a chart of 2008 and timelines. And I said the spring will be the Bear Stearns moment. And look, this spring, we had more banks fail than we did in the spring of 2008. And the dollar amount was greater of lost assets. All right. Now I said the fall will mimic Lehman Brothers, and this will be way bigger than Lehman Brothers. You can set a clock to this. This is amazing what's happening. Later this month, or later that month, New York Community Bancorp agreed to a deal with the FDIC to buy most deposits and certain loan portfolios, along with all 40 of Signature's former branches. So that part's already been taken, but the commercial real estate is the key. It says with the commercial real estate portfolio is about 15 billion of loans secured by residents that are rent stabilized or controlled. You see right now, I want you to understand that all these people that had their loans with Signature, they still have to pay. There's a lot of people that are under a very serious delusion that thinks when the bank that holds your mortgage goes out of business, that you magically get to keep your house and you don't have to pay anymore. That is so far from the truth. It's insane. There are going to be people that are planning on this and spending money today thinking that tomorrow they're not going to have bills. I know this to be true. The same thing happened in the early 80s with this end of the world thing. I know people personally that liquidated everything they had because they thought they weren't going to be around, and then boom. It's the same thing that's happening right now. People think they're going to get out of this, but they're not. The FDIC sale is somewhat unique as it has a large concentration of rent stabilized properties as collateral for the loans. See, I want people to understand this too. This is the same thing as salting. The term was called salting back in 2008 when all these mortgage-backed securities were imploding. They're like, how could this happen? We're looking at this AA graded credit worthiness of this tranche of debt. And what they found out is they just sprinkled some good debt on top. They had good portfolios thrown on top of the major portfolio, and everything below it was like an iceberg, was complete crap. The ice that you saw on top floating looked amazing and pristine. Everything underneath, which was 10 times bigger, was horrible. So they're using this example. Hey, we want to sell this portfolio that no other bank wants. You know, the pros in the industry that do this for a living, nobody wants to touch it. All right, we're going to figure out a way to sell it. This is true right now because they're saying, oh, look, there's rent stabilized. Look, there's multifamily residential. What happens with those residents can't pay their rent? How many people, type one below, believe that right now there are so many people, more people than not, more people that can't than can make their rent. And they're just a couple of months from I'm done. And think of it this way too. Think of all the people in the country with the student loans. Student loan debt is the only debt that cannot be discharged through bankruptcy, right? They've been holding on, winging a prayer, 2 years. They haven't had to make a payment. Now they got to make that payment. What are they going to choose? Well, do I stop making the student loan payment that can't be discharged through debt, or do I stop making my rent? And I know that there's rental laws in the state that I'm in that are going to protect me, and I've got X amount of months before they can evict me. And as a matter of fact, I've been programmed in the last 2 years because of states like California and New York and other places that have told landlords, no, they don't have to pay you. We're going to take care of you somehow, but they don't got to pay you. Think about this travesty that is about to hit our shores in the fall going into winter. This is going to be a remarkable opportunity. In my opinion, the greatest opportunity that you've ever had, but you've got to be willing to teach yourself, learn the knowledge, get around people that have been around this cycle, the last cycle. And the sad thing is there's very few of us out there that were investors prior to the Great Recession that saw the signs on the wall and actually, the writing on the wall and actually did something about it. Most people were greatly affected by the Great Recession. It says, since the FDIC has legal obligation to preserve existing affordable housing for lower income people, the agency said it plans to place all those loans within joint ventures in which the FDIC would retain a majority of the equity interest. The reason why this is because they can't sell this portfolio. And it is so important that you understand this. This is why so many other banks are going to crash. The banks are insolvent. They don't have the money to invest. This is really akin to the biggest part of the, when Lehman Brothers crashed, and if the Fed was having to run around and try and convince other banks and eventually force banks like Wells Fargo to take portions of Lehman Brothers because everything was imploding. Tarmco, thank you so much for the super chat. I think it's very important for people to understand how serious these times are. And if you're not ready, you're going to be left out in the dust. New York City and state housing authorities, as well as community groups, are providing input to the FDIC as it begins marketing. The FDIC said it expects to complete any portfolio sales by the end of 2023. And I believe that these sales are going to happen, but it's going to happen at such a reduced rate. What's going to happen is a bank's going to agree, probably forced to agree, to buy these assets, but then they're going to get some favors through the FDIC on the other end, like they're going to get discounted insurance rates. I'm not joking. I believe that's what's going to happen, and you need to see the writing on the wall. All right, this is the next story, and I think it's very, very important. And just so you know, as people got on, I had made an announcement at the beginning of the video. As of the end of this week, I will no longer be ever selling that real estate course because I went to a consultant and they went through the course and they said, don't ever sell it again for 80% off. So I'm making that announcement a couple times so that I don't get a flood of emails and people are saying, all right, so I put the discount link there. After that, because we're even adding more and it's already so big, I can't do it anymore. So just letting you know. This is out of biz.crass.net. Analysts, U.S. banks hold, and this is from analysts saying this, U.S. banks hold $3.3 trillion in cash amid banking crisis and recession worries. So banks are moving to cash. Why? They need to sustain themselves, but they want to buy up your assets for pennies on the dollar. They want the money to be able to do it and the backing to be able to do it. They know that as things get more intense, they've already seen a mini bank run in the spring. They need to be prepared for that to be able to stay solvent so that they can be the last bank standing. That is the game. You don't have to be the strongest. You don't have to be making the most money. You just have to lose the least in a crash, and then you go and crush it and pick up everybody's assets for pennies on the dollar. All right, it says here the U.S. lenders are hoarding piles of cash as insurance against a slowing economy persist. Deposit outflows and tougher liquidity rules that could hit medium-sized banks in particular. I hope you're understanding this. I hope you're digesting this. This buildup is another example of the risk adverse outlook of a sector that is still trying to find its footing after a series of springtime bank failures that resulted in restrained lending. Let me explain something else. When I was saying last quarter that you need to do this, you guys need to start looking at, I don't know, it's not financial advice. I told you what I was doing. I'm moving to cash. I'm settling down. I'm moving more to cash. I sold off a third of my stock portfolio back, 5 months ago. I made that announcement. It's held very good for me. I I'm accumulating cash to get ready for downturns, spooky times in the stock market, spooky deflationary spikes down, and the reality of in the news covering real estate downturns and stuff, and some mass panic. Right. This is what the banks are doing. People would quote something that Warren Buffett would say, and look, Warren Buffett's not selling. And now it's official because the next quarter came and you just found out the truth that Warren Buffett is moving to a massive cash position this last quarter. My timing held. For anyone sitting there thinking about what Warren Buffett's latest quote is, you need to understand one thing. Warren Buffett is invested in real estate and stocks. And the last thing he wants to do while he's selling quietly at high prices is cause you to panic, you to sell, and then his portfolio go to crap. That's how the billionaires talk. And no one's going to tell you that online. I don't see anybody on YouTube sitting there talking. You know what they're doing? They're just like rereading and talking about what Warren Buffett just said. They're puppets. They're just, Bob, this is what he just said. I'm telling you what they're doing. And now it's proof. And I bet that next quarter's numbers, third quarter, when that third quarter's released, you're going to see that Warren Buffett and his company liquidated more stocks. All the time talking out of the side of his mouth, like, oh yeah, if and this is one of his latest quotes, just keep buying, just buy. You want to be successful, just buy, just buy. Think about that. See, Warren Buffett and the banks need healthy economy to buy all the crap that they package up, all the securities they put together and sell to you. Billionaires aren't made by investing in stocks. Billionaires are made by building companies privately and then selling to those shares to you on the stock market. That's how all the billionaires became billionaires. Owning a business private and taking it public. I am doing that. I work in that realm too. And I can tell you from example, it works. I buy stocks before they go public. And there is money to be made. But I would be remiss not to show you why this happens and how it happens and how important it is to understand this system. So let's dive back into this story. Banks are accumulating cash right now. You need to realize how big of a deal this is. I'll read this section one more time. This buildup is yet another example of the risk-averse outlook of a sector that is still trying to find its footing after a series of springtime bank failures that resulted in restrained lending. I warned about this a year ago. It's a logical response to a slowing economy, and especially in a scenario where you're seeing an outflow of deposits and you need to conserve cash. This is from David Fanger, Senior Vice President at Moody's Rating Agency. Moody's is busy right now downgrading banks. Understand where we are. This is a big deal. I'm telling you what, if you had the ability to work under a coach or a mentor that had flipped a bunch of homes, built up, became a millionaire in like 2002, 2004, and then liquidated them all in 2006. And in 2008, the springtime was saying, get ready. You're about to see the greatest crash of your lifetime at that point in real estate. And you're going to be able to take advantage of it over the next 2 years. What would have your life been like now? And that's what I'm telling you right now. This is the time to get ready, to listen. You want to be successful? You want to have the confidence you never had? Well, you know how that confidence comes? By understanding, knowledge, and I'm sorry, but having financial security. That is very, very true. Financial security brings a new level of confidence that I never had before when I was younger, and it helped me a lot. The collapse of Silicon Valley Bank and Signature Bank in March triggered mass deposit withdrawals and renewed focus on the lender's financial health. More recently, the sector suffered a ratings downgrade when S&P last month cut ratings and revised its outlook for several U.S. banks following a similar move by Moody's. Overall, U.S. banks had cash assets of $3.26 trillion as of August 2023, up 5.4% from the end of 2022. That was well above normal pre-pandemic levels through lower than in the weeks, or sorry, though lower than in the weeks immediately following the bank failures in March, Federal Reserve data showed. And what else is the Federal Reserve data showed? It showed that last September, over 700 banks came to banking companies, came to them and said, we're done, we're insolvent, we need help. And they hid that from you until they released that in a special statement in the spring, after all these banks had collapsed. The FDIC leaked video. The banking sector is collapsing. This is last November. They've told you. And the mainstream media is not putting it out there. I'm putting it out to warn you, to diversify your banks, to hold on to some cash, get ready for some deals, and get your mindset. Because I'm telling you what, the hardest thing about the Great Recession was diving back into real estate and people saying you're nuts, you're crazy, because they just seen 2 or 3 years of collapse, and then diving in at the proper time and knowing what your trigger points were, your financial investment, your real estate trigger points, and being able to pull the trigger at the right time and buy with conviction based off of knowledge and understanding. That's what you need right now. Look, we are in crazy times and it's going to get crazier. I'm going to put the last set of 80% off links by the end of the week. They're going to be done and we're never ever listening that together. Again, I think we're up to 33 lessons. I don't remember off the top of my head. And in the coming months, I'm going to be adding new sections to it. So there it is. Crash course, real estate crash course. If you want to learn this stuff, if you want to think differently, I love all the real estate agents and brokers that have taken it and given me their feedback and how it's changing the way they sell real estate with conviction and how they're going to absolutely crush it. You want to start thinking like it, not only an investor, a home buyer that just wants to buy their own home and save tens of thousands of dollars, then check it out. With that being said, the Economic Ninja is out.